So this is the net percentage of domestic banks tightening standards. This is, just for those of you guys that might not know what this is, are banks becoming, are they easing? So is it easier to start getting loans? Is it more of an expansionary time frame? Or is it more of a contractionary time frame where they're not wanting to lend as much? And typically if you don't lend, capital dries up. So what capital? Basically working capital. Like if someone wants to expand their business, they take out a loan, expand their business. That creates more revenues and more profits, so therefore they pay back that loan, and then they do it again and they can expand. It's really hard in general to expand businesses without getting capital first. So it slows down the process, and what ends up happening is it creates a economic contraction from that. So we saw that in COVID, right? That's what the COVID spike is. That was very abrupt, quick economic contraction, and then they eased off very quickly as lending standards dropped and reserves went down to zero, all sorts of different things. You can see this in 2008. You can see it in .com. You can see it even going into the early 90s contraction as well. And if we saw it back in previous recessions, you'd see it there as well. So it kind of rinse and repeats. So where are we at right now? Well, the juice from the COVID ended up kind of drying out, and then now we're in this tightening process, and that's because of inflation, raising interest rates to try to stop all that. This last one that just got released for Q2 is basically saying that more banks are tightening. So it has not actually started to go the other way. Now, less banks as a whole are tightening, but keep in mind that in order for this number to go up, it's got to be pretty aggressive. I mean, the very top side of this scale is 80% of all banks. And right now we've got 46.7% of all banks are tightening lending standards rather than easing. So keep in mind that this is getting a little bit worse, not better. That doesn't mean that we're necessarily in a bear market. And that's probably the question that I get the most. Hey, are we in a bull market? Are we in a bear market? Are things going to go up? Where do you see the markets, right? In general, we got a lot of different systems. So we've got option systems that really don't even care about the direction of the market. And then we've got things like macro portfolios that are kind of agnostic, but in general will set up for either a bull or a bear market. We have been set up for more of a bull market for probably 3 months now. Is that a bull market or is it a bear market rally, right? That's kind of where things end up going. There are macro indicators that say we are in a bull market, but there are also things saying that this is a contractionary time period. But this is the S&P 500, which is the dark blue back here. And then you've got orange, which is the inflation rate. And then you've got this teal color, which is the federal funds rate. So just imagine this is like these two components back here, this inflation and the federal funds rate, really does dictate quite a bit of the monetary policy. There is another factor in here that would be growth that I'm not looking at right now. So that's another variable that will be in there. And then there's also one more variable, which is relative inflation rather than CPI inflation. I'm not going to get into all of those crazy details right now, but we are going to talk about what an inflationary recession looks like versus a deflationary recession. So first, let's go through what a deflationary recession looks like. These are probably going to all stick up in your head really easy because we just had two really strong deflationary recessions. By the way, deflationary recessions are typically deeper and have longer bull markets also. So here's 2001, right? So there's that recession that lasted for, roughly speaking, 2.5 years. Here's 2008 that lasted for about a year, right? As far as from peak to trough in the actual stock market, right? Now the recession lasted much longer than that, but the assets actually started recovering prior to that. Now, what happens in an inflationary recession or in a deflationary recession? Typically, inflation is rather in control. Yes, the Fed might be raising interest rates. Yes, everything like that. But inflation isn't exactly like out of control, out of this world. It's normally hovering just a little bit above target. Let's call it, 4% or maybe even 3%. And you can kind of see that prior to the 2008, we kind of had, 4.21. Nothing too extraordinary for inflation back here, but something that, it was creeping up there. But eventually you get this big crack, and that's when all of a sudden the contraction in the growth starts to really pull down assets. And then what happens is the Fed ends up, in order to kind of spur everything back up, they start dropping interest rates and starting to print money and try to spur that inflation back in and to get the economy growing, right? So that's what happens in both of these recessions. It's a cycle. It takes a while. There are rallies inside of it, but it does take a while. Totally different than an inflationary recession. An inflationary recession is like something that happens in the late 60s and 70s. So in let's just talk about the 70 contraction. So the stock market's doing fine, everything's doing hunky-dory, everything's going great. But all of a sudden, inflation starts to go beyond a level that is relatively in control. Basically, what happened is the market became too hot. And we get a inflation that started to creep up to, as you can see back here, about 5.6. So that's far beyond that, 4, maybe 3.5 level of what typically sets up for a deflationary recession. So that's when the Fed really has to start hiking rates. Really, the monetary policy starts to get really tight. And that's typically when you start to get the dip, right? It's because the monetary policy actually is what's creating the recession, not necessarily a slowing growth creating the recession. In fact, the growth is there, but what's stopping the growth is actually the tightening of monetary policy. And that creates this quick, kind of push down that you end up getting. And then inevitably inflation starts to roll over on its own, right? And as inflation starts to roll over, so now keep in mind, the assets are falling as the Federal Reserve is tightening interest rates still, right? They are tightening down as the market is rolling over. Very different from the Federal Reserve dropping interest rates while the market is falling. So let's go to 2001 and 2008. Market starts dropping. What does the Federal Reserve do? Remember, they're teal back here. Market starts dropping. Boom, they just start dropping, right? Deflationary recession. They're trying to spur inflation. Here is another one. Market starts to drop. Boom, they just start dropping their interest rates. They start to, try to stimulate the economy. Go to inflationary recessions. Inflationary recessions, they're tightening. And then finally, when inflation starts to cool off, they start backing off, right? They start backing off when inflation starts to peak. Boom, you start another little bull market, right? Then inflation starts to crank back up again. What does the Federal Reserve do? Dang it. Start tightening again, and it creates another contraction until eventually inflation starts to peak out again, and then they can drop it again and then try to spur economic growth. Now, this is this boom-bust cycle. This Federal Reserve is attempting not to go through these boom-bust cycles like what happened in the 70s, so we'll see how it all transpires. Let's look at what is going on today. So today, market going up, inflation going up, Federal Reserve way late to the game, by the way. Way late to the game. We talked about this back in the end of 2021 when I was warning everyone that was actually a part of the services. We got something coming, people. So we were talking about that they were late to the game. Inflation was way too high. Boom. They start raising interest rates. We get a contraction, right? But they're raising while we're getting this contraction in assets. Then what happens, right? Let's look at an inflation recession. When does the bottom get set in? When inflation rolls over. That's the bottom. You get a rally. When inflation starts to roll over, boom, right here, there you go. You get a nice bull market again, right? So where are we at? We're rolling over in inflation. The Fed theoretically should actually, if we're doing a boom bust cycle, the Fed should actually roll over these interest rates, or should have already basically started at this point. They're not. They're holding it steady. They have not raised interest rates today because that's what happened today. So they're pausing. So we'll have this pause. Now, will they start contracting? The market is pricing in that they will contract. Let's go take a look at that. So the market for this next inflation rate cycle, they are basically saying that we are going to possibly go up by another basis point next meeting, but there is a potential that they won't, right? Then let's go out to September. What are they going to do? It looks like if they raise interest rates, they're going to pause again. November, pause. December, dropping, right? So just FYI, my economic models show that we are going to have a fantastic third quarter. I'm not saying that stocks are going straight up, but we should have a nice economic growth in the third quarter, and inflation should be relatively under control, which should be bullish for stocks. Fourth quarter is a totally different story, right? Fourth quarter is going to be very contractionary and could be relatively painful, and then the first quarter of next year is also going to be a little painful as well, because actually the first quarter of 2024 is projecting out that we are going to get a re-acceleration in inflation, and that is normally a cause for a retightening of interest rates, which would actually create a pretty deep recession at that point. It's a long way out, so models can change very dramatically, but I just kind of wanted to let you know kind of what's on the horizon, and then we'll go from there, because that is what I get asked quite a bit. So